Welcome back. Well, let's get to that interesting note that's come in from India Ratings and Research. And this note says that an increase in related party transactions with outside parties, despite a benign credit environment, perhaps exposes entities to uncertainties on returns as well as additional cash outflows in case we hit a slowdown patch. To talk about this, we have with us Soumyajit Niyogi, Director at India Ratings. Soumyajit, thank you very much for this call. So, the report that you came out with was very interesting because that's true. I mean, any sort of stress, related party transactions, a buildup in leverage, all these things have kind of moved away from our memory and mind because we've been in a very benign environment and credit quality and, credit environment. But just tell us, what is this rise in related party transactions that you're seeing? What do you make of it? And why are you concerned?
Yeah, thank you very much for invitation. Let me first clarify one thing, that although the rise in RPT is surprising amid benign credit condition, but not all RPTs are necessarily concerning. So like investment in JVs to foray into new segment as well as de-risking own balance sheet could be a part of the risk management philosophy of those anchor investors, and which is good in a way, it is not bad. But however, investment into entities where control resides with the promoter, sponsor, and have no strategic imperative, there is no clear-cut economic interest. These are concerning, and these chances of this could expose to the entities in additional cash outflows in the future and suboptimal return for the stakeholders, especially for the shareholders.
Okay.
So what the analysis, yeah, sure.
Just to take a step back, what's been the increase in related party transactions? Do we have a number?
Yes, exactly. So if I compare with the pre-COVID period, precisely FY 2018, we have done this analysis for more than 2,500 entities. And out of 2,500 entities or more than that, so we have found out in FY entities around 679 entities were actually disclosed related party transaction. And here we need to caveat one thing: the related party transaction, what we have accounted for, which are purely outside us, not within the subsidiary, which is good. And in FY 23, the number rose to 746 entities, which is not high. But in terms of the quantity, that time the total amount was around 9.5 trillion, which is currently at the 16 trillion. If I just put another perception, this 16 trillion RPT for the revenue of the total sample set is around 100 trillion, and the debt size of around 32.45 trillion.
So, Mr. Soumyajit, you are obviously worried about, as you said, related party transactions that are not happening within the company's own subsidiaries framework.
Right.
But these would be RPTs that are happening with other promoter entities, and what kind of companies are we talking about? I mean, AAA, SME, mid-size, what kind of companies where you're seeing this rise in related party transactions?
Right. So obviously there are the segregation that it is RPT group companies, RPT associates, enterprise under management, and RPT joint vendors. So interestingly, the two segments have shown a significant rise. One is RPT with others and RPT with joint venture. RPT's joint ventures, to certain extent, this is explainable that some of the entities, particularly auto ancillary or for that matter energy segment, so they are getting into the new technology investment. That is still okay, but RPT others is different. Now, the second question about the rating, yes, it is for the not only restricted to the AAA or AA rated entities. We have found out that even for the BBB rated entities are RPT high. Just giving you perspective. So what we have filtered where the RPT exiting 25% of EBITDA. That's simply meaning that the RPT is higher than 25% of their EBITDA. The amount for the BBB rated entities is relatively small, but it is around 58% entities having such kind of RPT, which is a little bit concerning because BBB, that means their credit worthiness, that the credit quality itself is not very healthy.
Okay. And just one more number. You said the overall related party transactions in FY23 stands at 16 trillion. Right. Do we know what percentage of these are done by into entities, promoter entities, where there may be no strategic benefit to the corporate, or the control does not rest with the company. So, which is where you're concerned about. So, what number is that as a percentage of 16 trillion?
So So one thing is that this is the exercise. It is more to do with the entity-specific number. On an aggregate basis, it does not show a very clear picture. It might so happen the amount is less, but for the entity where the credit matrix is low and having a significant share. Minimally, the number is around 20 to 25%, where we are saying that it needs to be looked. We are not saying this is a grave concern. We will be watchful. So out of those number 16, around 25% entities could have such kind of interest where the economic interest or the benefit accruing, it's not clearly visible.
And of that 25%, what percentage would be by the BBB rated entities?
It is small. It is small because, as I said, that the amount is not aggregate amount is not a very right comparison. Entity by entity would be a better choice.
Okay, all right. We'll leave it on that note, sir. Thank you very much for joining in and flagging this off. At least it's a trend that one must keep on the radar, the rise in related party transactions. Well, with that, we are almost completely out of time on this edition of Trading Hour. Leaving the markets looking slightly better because from red, the color has changed to green and the Nifty is now sitting on a gain of almost 36 points. We are at the day's high. That's where we take your leave. But the team of Halftime Report comes up next to carry the action forward.